So let's get started talking about moving averages. Now, in tonight's class, I'm going to share with you a couple pre-made presentations. These presentations are not copied into the live webinar. So if you would like to see these small presentations after the webinar, you can do so by going to YouTube and then look for Forex and CFD education. Not a search for Forex or a search for CFD. The name of the channel is Forex and CFD education. Then, once you get to the channel, look under the playlist for moving averages, and you'll see all of the recorded presentations from tonight's class. Also, I gave you a handout called ETS Capital Technical Indicators. This is a range of the most popular technical indicators work with moving averages. And this is only available during the live class, but if you see on your screen, there's a little download button. Download it now to whatever device you're using, and then you can move it around later. If you don't do this, you contact customer support, and they will email you the file once you've contacted them. Also, in tonight's class, I'm going to use the term security, but I might also use the word stocks. I might say commodities. I might say gold or oil. I might say Bitcoin or a cryptocurrency. I might say the euro. But the fact is, I'm not talking specifically about the euro. I'm not talking specifically about Bitcoin. It just gets very, very boring saying the word security, security, security over and over and over again. So I'm talking about any publicly traded financial instrument in which there's an open market. Okay. Period, Dan. But I'm going to just use all different terms so we don't get bored. Similarly, I'm going to intermix the terms investing and trading. Now, the fact is we're all here through ETX, and on ETX you're trading CFDs and you're trading. So we understand what the difference is. An investor takes a long-term position while a trader takes a much shorter-term position. Now, in either case, the basic concepts and techniques we're going to talk about fit both, but the fact is it also gets very boring saying trading, 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 trading. So I mix up the terms, but you get the point. Now, if you're here hoping that you'll get some answers to some general questions, like should I buy today? What will prices be tomorrow or an hour from now or next year? Wouldn't investing be easy if we knew the answer to these seemingly simple questions? But I don't have a crystal ball. I don't have a Ouija board. So if you're attending this class in the hopes that technical analysis has the answers to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you are attending this webinar with the hope that technical analysis will improve your investing, I have good news for you. It sure will. Now, why do we say technical analysis? Well, if you know or understand the general field of technical analysis, you could say it's everything and anything done on a chart, because all technical analysis is done on a chart. We could call it chart analysis. Now, there's many sectors of technical analysis. You have chart patterns. You have oscillators like MACD and RSI and stochastics, and then you have trend lines, you have support and resistance line. So there's many fields. You have chart patterns, you have trend indicators, you have oscillators, you have bounded oscillators. So tonight we're going to be talking about an indicator that is laid over top of price. Most indicators are laid below price to the price chart, but moving averages are put on top of the price action. Now, moving averages help traders make effective transactions by aiding them in evaluating the price history of a currency pair or related investment. More specifically, these averages make it easier for investors to interpret price fluctuation of an asset by smoothing out their random movements. So, one of the easiest ways to use moving averages is moving averages takes the noise out of the markets. A simple moving average just averages out the price and lets us see a clear image of where price is moving. So it takes some of the randomness out by smoothing them out. But that's only one part of moving averages, because that's only a simple moving average. Okay, and that's the bare bones. Technical analysts have harnessed a wide range of indicators over time, but the moving average stands out due to its simple, practical, and useful. By using it, traders can identify price trends as well as support and resistance levels of a particular asset we're looking at. Now, what's a moving average? Well, at its bare basics, a moving average is a type of lagging indicator that accumulates past price points and then averages them to provide a technical analyst with a better sense of where the security went over a period of time. So if you're looking at a 1 hour chart and you want a 10-period moving average, you would go back to the close of each of the 10 periods, add them together, and divide by 10. That's really simplistic, isn't it? Then we also have exponential moving averages. Exponential moving averages get a little bit more complicated because they're a more involved formula, because what an exponential moving average does, it actually gives more weight to the most current price movements. Because something that happened 10 segments ago isn't as valid as something that happened in the last 2 segments. So a lot of us use EMAs over SMAs. But the formula for calculating a moving average is simplistic. This can differ depending on the moving average type used. Now, when we say 10, and it's usually said 10-day, it means 10 time periods. So if you're looking at a 1 hour chart, it's 10 last 1 hours. If you're looking at a 15-minute chart, it's the last 15 minutes. If you're using a bar chart, it's the last 15 bars. I'm sorry, it's the last 10 bars on the 15-minute chart. So a simple moving average calculator uses the following formula. It sums up the closing values of all the periods considered and then divides the result by the period's number. This is the simple moving average method, and it has slight differences in other types of moving averages. Now, we say that we use the close price. Now, if you've ever been to my classes before, you know I've been trading for 45 years. I've been doing classes for 15 years. Okay. Typically, 45 years ago, everybody used the close. Period, the end. Because we didn't have computers. We didn't have all of this involved tools that we have today. And we didn't get data that fast. Today, because we have these advanced systems through the internet and these advanced charts and these advanced calculators, we can do anything. So some people, and there's all kinds of gurus in that marketplace trying to convince you to use the open price or to use the close price or use the medium price of the time period. But the fact is, it makes very little difference. If you're trading and you're a professional trader, you're going to use the close. But to give a simple example, the exponential moving average is giving more importance to the current price levels rather than the closing price of the candles that made the period. Between the SMA and the EMA is more accurate as it doesn't lag that much. So a moving calculation is not mandatory on closing prices. It applies to various other prices like opening and average ones and the day and so on. The closing price method is the most popular one and widely used. So let's go over to a live chart that I've got set up for us here. Okay, and we're looking at the Euro US dollar 30-minute chart for no other reason except this is my teaching chart. Okay. Right now, we see, and actually I'm going to change it from Japanese candlesticks over to bars only because this is easier for you to see. Okay. Now, I have used, I've simply put on the chart a 10-period moving average on a 30-minute chart. So each one of these, each bar is calculated and added to the previous bar's close, and then divided by 10. And we can see the moving average dropped on the chart. The moving average takes the noise out of the movement. Okay? And there's a trading strategy, it's called red light, green light. It will help you stay on the right trend, the right side of the trend line also. You would only buy an asset if you're considering a position, but you would only place buys when price is over top of the moving average, and you would only place sell orders when price was underneath the moving average. This green light, red light philosophy will always keep you on the right side of the trend. Now, when we click the settings, you can see that we have the color, the moving average, and then the inputs. So we're using the close, but like I said, today's modern charts, you can use the open, the high, the low, the close. You can use an average of the high and low, or the high, low, and close. You can use an EMA of the EMA. It gets beyond. So use the close. So that's a simple moving average. Now, if I were to drop on the 10-period EMA, which is now the blue line, that is the 10 period, so we're both using 10, but this is the EMA, the exponential moving average. The exponential moving average, as I said earlier, gives more weight to the most current price movements. So we can see the exponential moving average is actually slightly lower than the moving average, the SMA, the orange line, because it's reacting faster to the huge drop in price. So right now I'm going to turn off the orange line, which is the 10-period SMA. And what we have left on the chart is our 10-period EMA, and I'm going to also put on the chart a 20-period EMA. Okay, so these are both the same exact calculations, but we have a 10-period and a 20-period. Okay, because we can see the relationship between the two different EMAs, and there are many strategies that involve using two EMAs either as a channel. So when we were talking about the red light, green light, some use it with a combination of two moving averages, and you only buy over the top and sell under the lower one. And it gives you a more definitive direction because it's only a filter. The red light, green light scenario is only a filter to filter out trades that you may not be making. But you can see the SMA and the EMA are relatively the same, and have the difference is the calculation and the weight. So an EMA reacts faster to more current price movements. So that's why it's less of a lagging indicator than an SMA. But this can be adjusted by the time period you're using. How many time frames you're using. The longer the time period you're using, the longer if you're using a 30-day or 30-period SMA, it's going to react much slower because you're going back 30 bars. So it's only reacting is averaging out over 30. Okay, where if you wanted to reduce the lagging time, you could reduce it down to 10. But then you get more false information because then it's responding much quicker to price. But it may not be, price might have jumped and reacted for a few minutes, but it's not taking into account that the rest earlier today it just sat there and did nothing. So let's go back over to my PowerPoint, and we're going to talk about how and why you might use the SMA and EMA and all of those things that I just mentioned so you're not so confused. Okay, so all of us should have got by now how to calculate the EMA, the SMA. It was relatively easy. You never have to calculate, they just automatically dropped on your card. But calculating EMA is a bit more complicated, as this indicator gives greater weight to a more recent value in order to reduce the effective lag. To determine this moving average, a trader should begin by selecting the time period, for example, a 10 period, and then calculate its SMA, because the EMA starts with an SMA, a simple moving average. Next, the investor should figure out what the multiplier they will use to give the most recent data points greater emphasis. This multiplier will depend on how long the EMA is. And this is a standard calculation, but again, you never have to calculate. Okay, the multiplier is simply 2 divided by the number of time periods plus 1. So for a 10-day or 10-period EMA, we would use 2 divided by 10 plus 1, which would be 11, and that would give us an multiplier of 18.18%. If we were using a 20 period, it would come all the way out to a multiplier times 9.2. They're always going to come out to be the same. Okay, if you can use a 30 period, whatever it's kind of, but you see people use odd things. Like MACD uses a 26 and a 9. Sometimes you use a 6 and a 6. So you have to know, you don't have to know because the computer just does the calculation, puts it on the chart, but you should understand what these multipliers are. So once this multiplier has been acquired, the following equation can be used to determine the EMA. The multiplier, which you just saw, so we were using the 10-period EMA, would be 18.8% times the closing price minus the EMA for the previous day plus the EMA from the previous day. An exponential weighted moving average puts more emphasis on the current price rather than simply averaging the closing prices. It reduces the lag time by applying more weight to the more recent prices. So those are the two most popular. But we also have things like volume weighted moving average, displaced moving averages. So I want to share a presentation with you on moving averages, and then we'll come back and talk about the other types of moving averages before we talk about how you would actually use them into your trading strategy. So that was just a general summation of what I've been saying since we started the class. Now, we mentioned there are SMAs, EMAs, and weighted moving averages, WMAs. There is a relatively new concept in technical analysis, and it's one of the indicators that it's just becoming extremely popular because we do have these advanced type charting systems. Because just a couple of years ago, the amount of time that went into a displaced moving average, the calculation, to get it on your chart, not the calculation, but actually to place it on your chart, was not available in the computerized charts. So it's become so popular that I'm actually using it only exclusively for my trading. And I decided starting in May, we'll be actually doing a 1-hour class on displaced moving averages. But we're going to touch on it tonight. Okay. Now, a DMA is nothing but a different simple moving average. So let me explain why. Traders found that multiple time frames prices is slicing through various EMAs like there was no support and resistance. Okay. A simple moving average is just a simple little calculation. And they didn't, in our fast-paced markets today, and we're trading like in currency and four decimals to the right, these SMAs didn't hold water. They're reliable, but they really don't do us any good. So then we see the price reacting lower or higher in different time frames. Okay. So what a displaced moving average does, or to overcome this problem, traders are cheating a bit. A displaced moving average is actually a cheat. And we are using the same SMA formula. It's the exact same thing as an SMA. Nothing changes. So it's the same calculations, the same dot, the same outcome. But what we're doing is we're shifting it forward or backward in time to where we put that dot on the chart. So in other words, when you calculate an SMA right now, you put a dot in that same place on the chart, you connect all those dots together to get your simple moving average. Well, today we can push that dot forward 3 time frames. So say we're going to do that calculation, but instead of putting on a chart at the current price, we're going to project it out 3 lines in front of us. So it's on the chart before the price actually gets to there because we've displaced it. And the result is fascinating. Important support and resistance areas result using the same moving average, only that a small trick influences the outcome. So as you can see here on this chart, or this example, so here would be the simple standard SMA. It's the same exact calculation, but by putting the dots out a couple of time periods forward, what we do is we get that movement on the moving average later. And it gives us these new support and resistance lines and these new pieces of information because as price gets there, instead of being lagging, it's almost becoming a leading indicator. So we're not changing the numbers. We're just simply changing where we're putting it on our chart. And it's working extremely well. And like I said, I use it so much that I'm actually doing a class in May. We're going to have a 1-hour class. So watch for, we're in April, May, June. It'll be in June because May's schedule is about to go up and I'm just finishing writing the webinar. And then it has to go to compliance. It has to go through 20 people's verification process. So it takes a while for it to get approved. But you'll see it in the June schedule. But once a trader has calculated one or more moving averages of a security, a trader can use it in a wide range of purposes. Many investors utilize these indicators to determine what trend a security is following. So a simple moving average or an EMA put on a chart by itself is only giving us some rare raw information. But when we combine it together with other moving averages, we can then get fantastic pieces of information. For example, a currency pair could follow an uptrend or a period of rising values during a specific time frame. Most investors seek to identify these trends and then try to profit from them. Alternatively, a security may do the opposite and follow a downtrend over a period. When an investment behaves this way, it creates losses for any people or institutions owning it. So, however, investors should keep in mind that whether a security is rising or falling in value, there are many different ways that they can try to generate returns. So, we have to figure out what time periods we're going to use EMAs or SMAs on a chart, and then how much of a time period we're going to give on our charts for the SMA and EMA. And there's some standard ones. We'll get to them in a second. To take you back to the chart. Okay. And we now have on the chart our 10 period and our 20 period EMAs. Okay. I'm not taking 10 and 20 periods and telling you to use these. Okay. I'm just using this as an example here. So forget the number of periods. We always have what's called a faster and a slower moving average. Okay. And it's always going to be the same. The shorter time period, in our case, the 10, is a shorter time period than the 20. The shorter time period is always called the faster moving average. Why? Because the shorter the time period, the faster it reacts to price movements. The slower or the more time periods, the 20, will react slower because it's going back 20 periods instead of 10 periods. Okay, so there could be 3, but it's always the shorter one is going to always be the faster, and the longer one's always going to be the slower. And you need to understand this only in the fact is lots of strategies and lots of theories you're going to read are going to simply talk about the slower and the faster moving average, because they're not going to tell you to use a 12 and a 16 or a 22 and a 32. That's up to you. But they're going to tell you when you've got it on and you're doing the slower crosses the faster crosses the slower, it's telling you something. So as you can see here on this chart, okay, our blue line is our slower. This is the slower, this is the faster moving average. And the purple line is the slower moving average. When the faster moving average slashes underneath the slower moving average and falls below, that is considered a sell signal. So, but considered as a transaction signal. A lot of people will sell at that point where they cross over. So this is a crossover strategy. Okay. Here where the faster moving average crosses above the slower moving average, that is considered a buy signal. And this is quite popular in online trading and in short-term trading, and it's simply called a moving average crossover strategy. Again, the details of strategy is what time period you're using in the chart and how many time periods you're using in your moving average. Okay. And there's all types of gurus out there telling you their own strategy. Somebody you use a 46 and a 97. The fact is we all try to use the standard ones because they've been around for a long time. They withstand the test of time. Uh-oh, that's the wrong thing up there. Hold on a second. There we go. So it's worth noting that traders with different preferences may employ moving averages of varying length. For example, someone looking to invest over the long term may look at how a security performs over a time frame such as 200, whereas to get insight. Whereas most of us, we are day traders or short-term traders, and so we would stick to the 10 and the 20 periods and never more than a 50. Alternatively, an individual focusing on short-term trading might hone in on how a currency pair did during a 20, and like I said, whenever we say 20-day, we're talking about 20 periods. If you're looking at a 15-minute chart, it's 20 15 minutes. If you're looking at a 1 hour chart, it's 20 hours. It's each bar that you're counting. So as doing so will provide a sense of how the pair performed in the comparatively short time. So one more use of moving averages is to measuring the momentum of a given securities price and how quickly it is either ascending or descending. The whole point of determining momentum is that once an asset starts moving in a certain direction, it will likely keep going in that exact same way. Remember, the trend is your friend. So if a trader can identify the momentum of a security, they can buy or sell the asset or even take out long or short-term positions. To single out this momentum, an investor can look at what the financial instrument did within a short period, a medium period, and a long-term period. So in other words, these are not time frames. These are not lengths of your moving average. It's using it on seeing the moving average on a 15-minute chart, a moving average, the same. Say if you're using a 10-period moving average and look at it on a 15-minute chart, look at it on a 1-hour chart, and look at it in a 4-hour chart. So for example, if a trader wants to ascertain the short-term momentum of the euro-US dollar, they could look at either its 20 SMA or EMA. If instead they desired a better sense of how what the pair's long-term momentum is, they could look at the measure used as a period of 100 days or more. One more benefit of moving averages is that they can be used to determine an asset's support and resistance. Securities will often find support at important moving averages. For example, if the USD JPY recently increased over the course of a week and then this upward trend gave way to some sharp drops, the currency pair might find support at its 200 or 20-day moving average. And you'll be able to see these levels on your charts, and you can see them by actually looking at the wicks of the candles and the moving average line and find where they are. So many traders will expect securities to find support once they reach key averages and use other indicators in order to back up their forecast. In addition, these same investors will frequently make use of important averages to predict when currency pairs will run into resistance during their upward climb. So if an investor takes the time to master the moving average and then the many benefits it provides, they will have access to a wide range of tools they would not otherwise be able to harness. Now, what are the most popular moving averages? Now, this is up to a whole bunch of personalization, customization, and interpretation. In theory, there are an infinite number of simple moving averages. There's an infinite number of EMAs. So if you start thinking you can come up with some weird 46 SMA to beat the markets, let me stop you now. You're going to find all types of articles and gurus and people trying to pat themselves on the back. Tell you, they've got to know, always win, indicator for you. And they're going to tell you to use a 22 moving average by only using the open, and then use a 44 moving average using the close. And when those two cross over, you'll have the perfect buy scenario. The fact is, it's a crock. Okay, so while I do not advocate you following everyone else, it's important to know what other traders are looking at and for what clues. So the common use SMAs and EMAs are used by everyone only because they work. And really, varying your SMA by a one period doesn't make enough difference to make it worth doing. So the most popular for short-term traders or for the hyper trader is a 5-period moving average. Okay. Then we can go to the most popular for us to our type of trading is a 10-period moving average. They're popular with short-term traders, great for swing traders and for day traders. Okay. The 20 period is the last stop on the bus for short-term traders. So this is why a 10-20 crossover is a good crossover strategy. Beyond 20, you are basically looking at primary trends and not short-term trends. A 50-period moving average is used by traders to gauge midterm trades. And then the last or the biggest that's commonly used is a 200. But this is for investors. So, welcome to the world of long-term trend followers. Most investors will look for a cross above or below this average to represent if a stock is in a bullish or bearish trend. So some traders would tell you to try simple moving average trading systems where you buy and sell a price breaks the average on a closing basis. Unfortunately, this is not accurate. Oftentimes, assets will tick over or under a moving average to only continue in the primary direction of the trend. Now that I've given you just enough doubt before ever attempting to trade with the simple moving average, let's review a few ways to make money with SMAs. In the end, it all comes down to what you feel comfortable with and what your style is. The EMA gives you more and earlier signals, but it also gives you more false and premature signals, where the SMA provides less and later signals, but is also less wrong signals during volatile periods. So let me share a little presentation with you again on how you might use moving averages for trading. Now, to give you a word of caution, moving averages don't work well in ranging markets. When price ranges back and forth between support and resistance, the moving average is usually somewhere in the middle of the range, and price does not respect it that much. So when you see pricing congestion, you want to disregard what the moving averages are doing. It's not a good thing, not a good tool to be using. So on the screenshot over here, you see a chart with a 50 period and a 21 period moving average. You can see that during the range, moving averages completely lose their validity. But soon after the price starts trending and swinging, they perfectly act as support and resistance. Now, there's many indicators that combine moving averages. Bollinger Bands is one of the most popular ones that uses a moving average, and it starts off with a 20-period moving average in the center. Then, of course, we have one of the most famous, which is MACD, moving average convergence and divergence. And MACD uses the two-line crossover as the first derivative before it goes down its additional calculations. But that's why it's called a moving average convergence and divergence. So now you can see that moving averages are a multifaceted tool that can be used in a variety of different ways. Once a trader understands the implications of EMA versus SMA, the importance of the self-fulfilling prophecy, and how to pick the right period settings, moving averages become an important tool in a trader's toolbox. So thank you very much for joining us tonight. I hope I gave you some information that you find useful, and you'll start using SMAs and EMAs, and you'll understand the difference. And a moving average crossover strategy is a good step in building your trading plan. It's a good filter to filter out the right trades, and then just use some other pieces of information. But always use your risk management and your money management skills to decide what you're going to do once you get that crossover. And remember, in June, displaced moving averages. But in the meantime, fiddle around with displaced moving averages. Go look some information up, because it's becoming a great way to predict price movement. So thank you very much for joining us, and I'll see you on Tuesday with class number 3 of our foundations class. Have a great trading week, and thank you for supporting ETX. Good night now.